Have you ever felt, deep down, that while the world crumbles into crisis, some people seem to know exactly where to run? We are taught that economic collapse is an accident, an unpredictable storm born of bad luck. But history reveals a disturbing pattern, one that is almost surgical. Often, ruin isn't a miscalculation. It is a decision. Today, we pull back the curtain on the global elites and their hidden wealth, exploring how financial chaos may actually be a deliberate transfer of power. If this search for the truth resonates with you, show us you're paying attention. If this topic makes sense to you, hit the like button and tell us in the comments. Do you feel crises are inevitable, or are they manufactured? Your participation is vital. By subscribing to the channel, you aren't just following content. You are strengthening a community that refuses to accept the official narrative and seeks to understand the system as invisible control. It is your presence that allows us to continue investigating what remains in the shadows. But to understand how the game is rigged, we need to look at the moment before the fall. Long before the headlines announce disaster and panic takes over the streets, there is a silent, almost imperceptible movement that signals the end is near. Case 1. Capital flight before the fall. To understand the anatomy of a collapse, we must ignore the noise of the streets and focus our attention on the silence of the executive suites. There is an invisible choreography that takes place long before the first red chart appears on the news. Screens a subtle movement that escapes the gaze of the common citizen, but is glaringly obvious to those who know the backstage of financial power. The phenomenon of capital flight is not, as many think, a panic reaction. It is, in fact, a cold and calculated decision based on brutal information asymmetry. While the population continues its daily journey working, saving, and believing in the solidity of the national currency, there is a select group that has already received the starting signal. They do not view the economy as a social or patriotic commitment, but as a chessboard where the preservation of their own assets outweighs any collective loyalty. This is the hidden truth that is rarely spoken aloud. Smart money never stays to turn out the lights. It leaves through the back door, while the party still seems to be at its peak. Imagine for a moment the mindset required to execute such a maneuver. You have to know the ship is going to sink and, instead of sounding the alarm, sell tickets to first class. When the elites begin transferring their fortunes to tax havens or converting liquidity into tangible assets in other jurisdictions, they are effectively draining the blood from the local economic system. It is a silent transformation of public circulating wealth into private, untouchable security. The impact of this withdrawal is devastating, as it removes the foundation that sustains the currency's value. Without these reserves, the structure becomes a hollow shell, fragile, ready to implode at the slightest breath of instability. The revelations about these movements almost always emerge too late, in post-mortem reports or journalistic investigations that occur years after the disaster, when families have already lost their savings and the social fabric has already been torn. But at the moment it happens, everything seems normal. The banks are running, the shops are open, the government issues proclamations of optimism. Yet, the real vaults are being emptied electronically, transferred to Zurich, London, or Singapore, leaving behind only the illusion of solvency. It is crucial to understand that this is not bad luck. Those who control these hidden riches possess maps that we do not. They see the cliff miles before the road ends. Now, I want to go even deeper into this, because what is at stake is not just the movement of digits on a computer, but the philosophy of those in command. This early escape creates a vacuum. When capital flees, confidence evaporates, but selectively, the insiders protect themselves, while the masses are left holding a currency that loses value by the second. It is here that we realize the financial system is not designed to protect everyone's wealth, but to facilitate the mobility of the few. The real crisis does not begin when the bank closes its doors. It begins months earlier, when the liquidity that should guarantee deposits is silently reactivated. This process exposes a harsh reality about the nature of our modern economies. They depend on faith, and faith is the first thing the elites sell when they smell smoke. By withdrawing their capital, they are, in practice, betting against the very country that enriched them. It is a self-fulfilling prophecy. In trying to save themselves from a potential collapse, they precipitate the actual collapse. The speed at which this happens today is staggering. In the past, it was necessary to carry gold or physical notes across borders. Today, a single encrypted click moves billions, making detection almost impossible in real time. The average citizen, without access to these rapid defense mechanisms, gets caught in an inflationary trap, watching their purchasing power be decimated, while the architects of the crisis watch from a safe distance. This dynamic completely alters our perception of responsibility. We frequently blame incompetent politicians, and they have their share of the blame, but We forget the managers of great fortunes who, with their portfolio decisions, have the power to condemn a nation to poverty in the blink of an eye. They operate in a gray zone, legal but morally questionable, where the survival of capital is the only law that matters. And when the dust settles, they return, not as saviors, but as buyers acquiring the nation's devalued assets that they helped thus closing a perfect cycle of expropriation and Understanding this mechanism is the first step to stop being a passive victim of circumstance and start reading the signals the market emits before the thunder rolls. If this analysis on the silent flight of capital gave you a new perspective on how crises really begin, write the word invisible in the comments. I want to know who here is really paying attention to what is left unsaid. But the flight of money is just the initial symptom. For the collapse to be total, the rules of the game must be altered from within. Case 2. Policy decisions that drain the system. If capital flight is the blood draining from the economic body, then internal policies are often the tourniquet applied not to stop the bleeding, but to cut off circulation to those who need it most. Collapse is rarely a natural event like an earthquake. It is, more often than not, an architectural construction designed in the back rooms of central banks and finance ministries. When we look at the history of great crashes, we realize the trigger is almost never pulled by the common citizen, but by invisible hands operating the levers of liquidity. The official narrative that once sold to us on the nightly news always speaks of stabilization measures, necessary adjustments, or combating inflation. But the hidden truth behind these technical euphemisms is much darker. It is a controlled contraction, a programmed asphyxiation of economic activity that serves to clear the board. Imagine the economic system as a vast reservoir of water. Companies, families, small businesses, everyone depends on this flow to survive. The decisions that precede a collapse invariably involve closing the floodgates. Interest rates spike abruptly, credit becomes suddenly inaccessible, and currency stops circulating fluidly. For the small family business, this is a death sentence. For the worker with a mortgage, it is the end of the line. But for the financial elite, this is not a crisis, it's a clearance sale. This transformation of the market from an environment of growth to a scenario of scarcity does not happen by accident. It is orchestrated. Those who design these policies know exactly how long the population can hold its breath. They possess mathematical models that predict the social breaking point with chilling precision. Now, I want to go even deeper into this, because what is at stake is the very structure of ownership. When liquidity is withdrawn from the system, the value of real assets plummets. Real estate, factories, land loses its nominal value because no one has the money to buy. No one, except those who knew the tap was going to close and kept reserves for this exact moment. It is here that the mindset of the common investor collides violently with the strategy of the elites. The citizen sees the crisis as a time of loss. The system controller sees the crisis as a transfer mechanism. Policies of severe austerity or monetary restriction function like a trawling net that scoops up the wealth of the middle class and delivers it at rock-bottom prices into the hands of conglomerates that have the deep pockets to weather the economic winter. The impact of these maneuvers is generational. We have seen this happen in various emerging economies and even in Western powers. The restructuring that follows a collapse provoked by internal policies almost always results in an even greater concentration of power. Small competitors are eliminated, not because they were inefficient, but because they were denied financial oxygen at the critical moment. The revelations about who benefited from these policies only surface years later. When we analyze who bought the hastily privatized state assets, or who acquired the real estate portfolios of failed banks, cynicism reaches its peak when we realize that the same decision makers who created the bubble of easy credit are the ones who, years later, decide to burst it, claiming fiscal responsibility. This journey through the dark side of political economy teaches us that stability is often a facade for the stagnation of social mobility. Keeping interest rates artificially low and then raising them drastically is the perfect trap. You lure the population into debt with promises of eternal prosperity, only to change the rules mid-game, catching millions off guard. Those with access to inside information, the cronies of power, the big campaign donors, the interlocking boards of directors adjust their positions months before the policy shift is announced. They fix rates, sell risky positions, and hoard liquidity. When the announcement is made and the shock hits the real economy, they are armored. The suffering of the majority becomes the fuel for the expansion of the minority's empire. It is not just about greed, it is about control. The people worried about immediate survival, afraid of losing their home or job, is the people that does not question authority. Policy-induced collapse also serves to discipline the workforce, drive down wages, and dismantle acquired rights, all in the name of necessary recovery. It is social engineering disguised as economic science. And the most disturbing part is that, technically, everything is done within the bounds of legality. Laws are written by those who benefit from them, and exceptions are created for those who can pay for them. If you can see now how economic policies can be weapons disguised as tools, write the word system in the comments. I want to see who here understands that the stability of the few costs the ruin of the many. But even when the system drains everything it can, there remains one last sacrifice to be made, one that touches the very essence of the value we carry in our pockets. Case 3. Sacrificing the currency to save real wealth. When the financial architecture begins to crack under the weight of unpayable debts, the guardians of the temple face an impossible dilemma. Save the system or save the promise made to the people? History shows us, time and again, that the choice was made long before the crisis erupted. The sacrifice of the currency is not a bump in the road. It is the final relief valve, the emergency mechanism triggered behind the scenes to prevent the true power structure from crumbling. For most people, currency is an end in itself, the goal of a lifetime of hard work. We accumulate notes, digits, in an account, believing they represent security. However, for those operating in the highest spheres, currency is merely a disposable tool, a shock absorber designed to take the hit when the collision becomes inevitable. The hidden truth is that brutal devaluation or hyperinflation functions as an unlegislated tax, a confiscation that requires neither parliamentary vote nor public approval. Imagine you spent decades building a reservoir of savings, only to discover that the water you stored evaporated overnight. This is the tragic journey of the common saver during a monetary collapse. While they watch their purchasing power dissolve like ice in the sun, they observe with disbelief that certain groups seem immune to the disaster. This happens because true wealth has never resided in printed paper or bank balances. Real wealth is tangible. It is productive land, gold mines, real estate in strategic locations, stakes in essential companies that charge for their services in whatever currency replaces the old one. The decisions to convert liquidity into solid assets are taken silently, months or years before inflation starts to gallop. It is a portfolio transformation that definitively separates those who own assets from those who own illusions. Now, I want to go even deeper into this, because there is an even more cynical dimension to the sacrifice of currency: debt elimination. In a credit-based system, who are the biggest debtors? Almost always, they are governments and large, state-linked corporations. When the currency collapses, the real value of those debts collapses with it. If inflation hits 1,000%, old debt becomes, in practice, irrelevant. It is a financial reset, a cleaning of the balance sheets that allows the system to start from scratch, but at the cost of annihilating the middle class and retirees. This utilitarian mindset, which views the national currency as something that can be burned to warm the economy of the privileged, is hard to accept for those raised to believe in the sanctity of money. But historical revelations, from the Weimar Republic to modern crises in South America, show the same pattern. The currency dies so that the elite's assets may survive. The psychological impact of this phenomenon is devastating. It breaks the social contract. When money loses its meaning, society loses its moral compass and its sense of value. Work stops paying off. Speculation becomes the only means of survival, and trust in institutions evaporates. Yet, in the midst of this chaos, there is a disturbing calm on the top floors of the skyscrapers. They know that chaos is temporary, but ownership is permanent. Whoever holds the title deeds to a factory remains the owner of the factory, regardless of whether a loaf of bread costs 10 or 10 million currency units. In fact, for the holder of real assets, inflation can even be beneficial in the short term, nominally inflating the value of their wealth while their debts turn to dust. We are talking about a wealth transfer of biblical proportions, operated not through production or innovation, but through the manipulation of the common denominator of all exchanges. It is a technical expropriation, complex enough not to be immediately understood by the masses, but simple in its results. Families are forced to sell their goods, grandmother's jewelry, the family plot, the extra apartment just to buy food or medicine, handing over these real goods at fire sale prices to those with access to strong foreign currencies or stores of value. This is where inequality is cemented, not for decades, but for centuries. The one who manages to cross the desert of devaluation with their assets intact emerges on the other side as a giant in a land of financial illiberation. This process clears the game board. It eliminates the small players, dissolves the savings that could allow for social mobility, and consolidates power in the hands of those who already held it. The death of a currency is not the end of the economy. It is only the end of the majority's participation in the economy. The scenario that remains is scorched earth, where the old rules no longer apply and old values no longer serve. But it is precisely in this desolate landscape, where despair is the only current currency for the majority, that the final act of this economic tragedy is prepared. Because when everything is worth zero to the common citizen, everything is for sale to those who kept the right currency. If this reflection on the fragility of the money we carry in our wallets has changed your perception of value, write the word value in the comments. I want to know who here understands the difference between price and wealth. But now that the currency has been sacrificed and the population is on its knees, the stage is set for the most aggressive move of all, the one that defines who will own the future. Case 4. Why collapse might be the endgame. Collapse, in its most brutal and definitive form, is not the end of the story. It is the beginning of a new chapter, written exclusively by the winners. For the majority, the fall of an economy looks like the end of the world, a cataclysm where the known order disintegrates, leaving only uncertainty and fear. However, for those watching from the ivory towers, the collapse is viewed as the great liquidation, the supreme moment of acquisition, where chaos serves as the most efficient tool for market clearing. The hidden truth permeating this final stage is that destruction is not a bug in the system, but a necessary feature for resetting the accumulation cycle. A radical transformation in asset ownership occurs here. What once belonged to the many small businesses, family homes, national resources passes, in a short space of time, to the very few. It is the final consolidation, where competition is eliminated not by innovation or quality, but by the simple inability to survive the financial winter. This phase reveals the true mentality of the elites operating behind the scenes. There is no empathy for social suffering, only a cold calculation of opportunity. When there is blood in the streets, as the old financial saying goes, it is time to buy, and they buy 4 pennies what is worth millions. The middle class, exhausted by inflation and unemployment, sells off its assets at any price to guarantee immediate survival. It is a voluntary wealth transfer under duress, where the desperate decisions of those losing everything feed the hunger of those with the liquidity to wait. The impact of this on the social structure is permanent. It creates an unbridgeable chasm between the owners of capital and the workforce, which, stripped of assets and protection, becomes more docile, cheaper, and easier to control. Now, I want to go even deeper into this, because collapse as a final strategy goes beyond simply buying cheap real estate. It is about rewriting the social contract. In times of peace and prosperity, the population resists the loss of rights, the privatization of essential services, and the erosion of sovereignty. But during the panic of a collapse, resistance crumbles. The unacceptable is accepted in the name of salvation. Draconian austerity measures, the sale of critical state infrastructure to foreign groups, and the total deregulation of labor laws are implemented without opposition. The shock paralysis of society, ensuring that the revelations about the new economic model are only understood when it is too late to turn back. It is the engineering of consent through trauma. Those who hold the hidden wealth know that, amidst the rubble, they can dictate the new rules of the game rules, designed to guarantee that their hegemony is never challenged again. The journey through this economic desert changes the very soul of a nation. Hope is replaced by survival, and dreams of social climbing give way to gratitude for having the bare minimum. This lowering of expectations is crucial for the new economic regime. A workforce that fears losing the little it has left is a workforce that does not strike, does not demand raises, and does not question authority. Collapse, therefore, fulfills a disciplinary function. It corrects what the elites consider to be the excesses of the previous prosperity: wages that were too high, social benefits that were too generous, a middle class that was too independent. By destroying the economic base of that independence, the system restores the rigid hierarchy that suits it. We see, then, that the crisis is not a random event, but a mechanism for power concentration. Assets change hands, moving from the public and diffuse sphere to the private and concentrated sphere. National debts are restructured to bind governments to eternal creditors, limiting the political autonomy of future generations. The country that emerges from the collapse may have the same name and the same flag, but its owners have changed. Fertile lands, energy grids, water systems, and key industries now figure on the balance sheets of corporations that have no face and no homeland. To those looking from the outside, it seems like a tragedy. To those inside the circle of power, it was just a successful business Tuesday. This is the harsh reality of a world where the economy does not serve people, but people serve as fuel for the economy. If you can perceive the strategic coldness behind what they call recovery, write the word reality in the comments. I want to know who here has already lifted the veil of illusions. But if all this was planned, if the collapse was a choice and not an accident, we are left to face the most unsettling question of all, the one that forces us to look at the future with different eyes. We fear economic collapse, and but fear masks a deeper truth. Collapses do not wound everyone equally. Some prepared for it. Some chasse italiano, fortunes vanish. Systems shatter, but hidden wealth endures. The real question isn't why economies fall. It is who is already standing when they did. If this has shifted how you view economic crises, subscribe for deeper investigations. Share this with someone who still believes collapses are random, and stay curious.